Hello, my name is Amog Mangal, and welcome back to the series of videos where we aim to inform people around the world about the stock market and essential concepts related to it, which we can use to make informed investments and decisions related to the market. In this video, we will be talking about quantitative analysis of stocks, which is a crucial skill for any investor looking to make informed decisions. From PE ratios to earnings per share, we will cover all you need to know. Quantitative analysis involves crunching numbers to evaluate a company's performance and stock value. It's all about the hard facts, the figures that tell the true story of a company's health and potential for growth. Within quantitative analysis, we can discuss and analyze various concepts like profitability, growth, valuation, assets, liabilities, cash flow, and shareholding. Each of these are very important in finding out the health, business model, and overall performance of a company. First up, we must discuss profitability. Under profitability, we have many different types of profits. First, we have gross profit. Gross profit is basically the revenue minus the cost of making the product. Then comes operating profit, which is the gross profit minus the profit after paying for the business operations. Then comes net profit, which is the profit after paying everything, which even includes interest and tax, depreciation, and everything. Profitability basically tells you how efficient the company is and how efficiently the management is running the business. Then comes valuation. For valuation, we can use two basic and very useful metrics. First is the price to earning ratio or PE ratio. This is one of the most popular metrics in the stock market. It compares a company's stock price to its earnings per share, or basically the amount of money it makes per share, which is revenue divided by total numbers of share. This gives the investors an idea of what the market is willing to pay for each dollar of earnings. The next comes earning per share or EPS. This measures the amount of profit that a company makes per share of its stock. It's a direct reflection of a company's profitability and a crucial component in calculating the PE ratio. And increasing EPS over time signals a growing company, while a particular P ratio range shows shows correct valuation. A valuation from 20 to 50 shows that a company is valued correctly. This can vary based on industries. Anything higher than that can show that a company is overvalued, which means that the stock price is more than the intrinsic or realistic value of the company. A P ratio under this can probably show mishaps in the data or irregularities in the data that have been provided in order to calculate the P ratio. Or in some good cases, it could also mean that the stock is actually really, really undervalued. Next up, we have assets and liabilities. Assets are resources owned or controlled by a business or individual that are expected to produce economic value or future benefits. These can be classified into various categories such as current assets, non current assets, tangible assets, and intangible assets. Current assets are assets that are expected to be converted into cash, sold, or consumed within 1 year. Non-current assets or long-term assets are assets that are expected to provide economic benefits beyond 1 year. These are usually long-term assets. Then intangible assets are physical assets like buildings, machinery, vehicles, and inventory. Intangible assets are non-physical assets like trademarks, patents, copyrights, customer lists, and goodwill. On the other hand, liabilities are obligations of a business or an individual that arise from past transactions or events, which are expected to result in an outflow of economic resources of financial value. Like assets, liabilities can be categorized into current liabilities and non-current liabilities. Current liabilities are obligations that are expected to be settled within 1 year or within the operating cycle of the business. These include accounts payable, short term loans, credit card debt, expenses, and other short term borrowings. On the other hand, non current liabilities or long term liabilities are obligations that are due beyond 1 year, such as long term loans, bonds, payable bonds, deferred tax liabilities, long term leases, and pension liabilities. Now, obviously, since liabilities are things that take out money from a bank account and assets are things that put money in your bank account, assets should always be growing and more than liabilities, as those are the things that can be liquefied in order to protect yourself against liabilities. Next up, we have shareholding patterns. Shareholding patterns basically show how ownership of this company has changed over time. In shareholding patterns, we can usually see four major parties: the promoter or the founder and owner of the company, FIIs or foreign institutional investors, then domestic institutional investors or DIIs, and finally retail investors who are investors like you and me who are the general public. And that's a wrap on today's deep dive into quantitative analysis. I hope this breakdown helps you feel more confident in assessing stock values and making more informed investment decisions. Quantitative analysis is a powerful tool, but it's just one part of a successful investment strategy. Thanks for watching.